Now with VA, you can add those new costs into the loan amount, but as a benefit to the borrower on this loan product, you have to recoup the closing costs from your savings within 36 months.
Service members should get the most out of their VA benefits for homeownership. That's our belief, and that's why we're here. So whether you're looking to own your dream home, considering refinancing, or just exploring the VA home loan process, you've come to the right place. Welcome to Helping Heroes Become Homeowners.
Should you be in the market right now to refinance your VA home loan? Hi, my name is Richard Sarey. I'm with Alliance Mortgage Group, and I am your podcast host for Helping Heroes Become Homeowners. Let's dive in and see why a VA refinance would be beneficial for you as a veteran or active duty member to help lower your payments, and talk about some of the things that you need to have put together to see if you qualify for that. So on a VA IRRRL, interest rate reduction loan, you're going to need two things. You're going to need to make that payment on time. Can't have any lates on that mortgage payment. You need to at least make 6 months on time, right? You have to have at least 6 months payments made, and you have to have 210 days have come and gone since your last transaction. All that has to have come through in order to qualify for the VA refinance. Now, a couple of things too, as a consumer, you got to make sure that you're lowering your rate at least 0.5%. 0.5% is the minimum rate reduction required by the VA to show a benefit to the veteran. So when you're putting that loan together or getting numbers, seeing what the market rates are doing, you're going to want to make sure that you're getting that benefit of at least 0.5% or more. Now, closing costs, there are going to be closing costs incurred on the loan. You're going to have title cost. You may have a doc prep. You do not need an appraisal. The credit report is going to be a mortgage-only credit report, which means we're just going to have credit scores and your mortgage history pooled. That's all we're going to see. Your other debt load, again, it's a non-qualifying. You've already qualified for the loan once before. So there's no necessary assets needed. There's no income needed. So it's a very easy process to redo the terms and get that benefit of a lower payment. But going back to closing costs, you're going to have title costs incurred. You're going to have doc prep. No appraisal. Again, as I mentioned before, you should not have any lender fees and no processing fee or an admin fee. And then you're going to have your escrow set up on the new loan. So if you're escrowing now, which you should be, you're going to have taxes and insurance put into the new escrow account. That's going to be part of the cost associated with the new loan. Now with VA, you can add those new costs into the loan amount, but as a benefit to the borrower on this loan product, you have to recoup the closing costs from your savings within 36 months. Now, not all of those closing costs are included in that bucket. Your escrows and prepaids, your prepaid insurance or interest rather is not included in that calculation, just a third-party cost associated with that. You have to make sure that you're recouping those costs within 36 months from the savings from your old principal and interest payment to your new principal and interest payment. Now, some veterans, you're going to incur a funding fee on these refinances. If you're not exempt or you have no disability rating, you're going to have 0.5% funding fee added to the loan amount in order to do this loan. Now, if your certificate of eligibility shows that you have any disability rating, 10% or higher, you're not going to have that funding fee. That funding fee is waived as it was possibly on your purchase loan. So that funding fee could be incurred if you're not exempt from that. Now, as I mentioned earlier, credit score is going to determine the interest rate. You're not really requalifying for the loan, but you are going to get the terms based on the credit score. Your mortgage history paid on time is going to determine if you're eligible for this product. So if you have a late within the last 12 months, it's going to be a little bit of a challenge to have that done. Some lenders may give an exception to that 1 month, depending on when it occurred. If it was recent, you're probably going to have some struggles. But if it was on maybe month 10 or 11, that would be something I would contact my underwriter to see if that's something we can maybe get a letter of explanation on and move on down the road with that refinance. Now, your escrow setup, it's how we determine escrows. There's a couple of different ways. So your escrows are determined when your taxes are due. In my state, Texas, it's every December. Your homeowner's insurance premium is going to tell you when it renews and expires. So on the renewal time of that premium page from the binder is going to tell us how many months we have to set up for the insurance. The taxes, again, are due in December each year, so we are going to set that up accordingly. Now, when you put that loan together, or when I put that loan together, I'm going to make sure that we can possibly net the escrows off your payoff, or once that lender receives the payoff from us, you're going to get the escrow refund back to you. Those dollars you can do whatever you want with. You can maybe pay off some debt. You can apply it all to a first payment as a principal reduction, or you can put it in the bank and put it in savings. It's your dollars. Our loan is going to set up that escrow account and include that in the loan balance. The new amount we're going to refinance, we're going to include that in that dollar amount. Now, again, that doesn't get figured into the recoup amount that we have to save you in terms of payment, but it is figured into the loan amount. If we net the escrow out of your payoff, that just means your payoff is going to be reduced by the amount of dollars they have in the escrow account to lower the amount that you need to finance on the new refinance. So when we do these loans, there's a couple of things that we're going to need to determine whether or not there's going to be a benefit for you. It's a very simple process. We just need current mortgage statement, your current homeowner's insurance policy that shows us the premium, the renewal date, and also the estimate on what you think your credit scores are. And we can pull a soft credit pool on that and make sure we have an exact dollar or exact credit score, all three bureaus, to give you a better accurate figure on that. But if you have a general idea what the credit scores are, we don't have to do a soft pool yet. And we can just work up the numbers and see if there's going to be a benefit to you with the current market rate. I strongly recommend that if you have a loan that you originated 2 years ago, last year, to take a look at the opportunity to lower your rate. Because on these loans, you can do a streamline every 6 months, every 210 days. Now, make sure that we're not extending that balance out each time we do that. So you want to make sure that when we're putting that loan together, we're not extending that balance out further than we have to, just to save maybe $100 a month on the payment. It wants to be a little bit more aggressive savings than that. Make sure the cost benefit is still there for you as the veteran. We don't want to put you in a worse situation. So if you want to contact me to get that information, I'll leave all that information on the podcast, how to get a hold of me, my email address. Strongly recommend that you at least give us a shot, see what we can do for you. Now, if you're outside of Texas, there's a couple of different other cash out or other VA loans that you can do. You can do a type 1 cash out and a type 2 cash out. If you want to reach out to me on those, we can go into more detail over the phone on what those loans look like. But you can utilize your VA refinance in a different way if you do not want to do a streamline process on that. So I'm hoping everything that you listened to today was beneficial. Get out there, get on the phone with me. Let's see if we can get lower that interest rate now. If we're wanting to wait and see what the market's going to do, the market's already priced in what the Fed's probably going to do here in the next couple of months. So the only thing that might change their decision to do something in September or further in the year are these economic reports. We got a couple coming out next week that may give us a little bit better price, or it might give us worse price. So if you like what you see now, I would definitely get it locked in, take advantage of your savings, and then see what the market does next year. And we can do that cycle again just to make sure it makes sense and that we're saving you money. So I want to thank you for listening today. If you have any questions, you can always reach out to me via my email address at rsarey@alliancemtggroup.net, or give me a call on my office line 214-872-2188. Thanks for listening, and we'll talk to you soon.
If this episode has been beneficial, we'd love to hear from you. Please leave us a review on your favorite podcast platform. Also, for regular updates and tips, make sure to follow our social media channels, which you can find in the show notes. Until our next episode, keep making homeownership dreams come true.